You're focused on growing your investments, but what about the cash that's just sitting there? After taxes and inflation, even cash in a high-yield savings account might be falling behind. That's where Smart Yield by Carry comes in. It's an investment product that automatically moves your cash into high-yield money market funds. Here's how it works. Smart Yield scans a strategic list of money market funds every single day, then compares them based on your personal tax situation. Some of these funds can offer special tax advantages, like no state and local taxes, no federal taxes, or even both, depending on where you live. And when a higher yield becomes available, Smart Yield is designed to reallocate your funds automatically. No spreadsheets, no guesswork. Just another way Carry aims to help you keep more of what you earn. Learn more about Smart Yield at carry.com/smart.
All right. What's up, everyone? Super excited to see you all. For those of you that haven't met me, my name is Ankur Nakbal. I'm tuning in from a beautiful sunny day in Brooklyn, New York. Type into chat. Let me know where everyone is coming in from. And we'll soon get started with today's presentation on understanding and negotiating equity for startup employees and founders. All right. So I'll read the answers as they come in, but we'll also start going through the content. There is a lot of stuff to cover today, and I'm going to try and wrap it up in about 40 minutes. So that's my little goal over here. Looking at the chat: Kansas City, Connecticut, New York, Boston, DC, Virginia, Kansas, Miami, Israel, Bangalore. So a caveat that a lot of what I will share today is based on how equity works in the US. However, a lot of people who have international companies may still have a US company, and there's a lot of parallels in local places as well. So take that in mind. We'll base everything on the US, but lots of lessons no matter where you're tuning in from. So why is today's workshop important? This is an issue I've honestly felt very strongly about for quite a while, but I think startup employees typically do not understand the nuances of their equity despite it being a big part of their compensation. If you're a first-time startup founder, I'm going to give you a few actionable tips to improve outcomes for the rest of your team. As an employee, typically, you only have one job at a time. So the equity is more significant than an investor. With an investor, you may have hundreds of bets. You just need one of them to work out. As an employee, you can only work in one place at a time. You can only get equity in one company at a time. And my goal is to prevent this lack of knowledge and make sure that no one ends up getting exploited by the companies they work for. Hold on, I'm going to turn on the air conditioning. It's a little bit warm here, but let me know if the sound is getting annoying. Jenny saying, wondering if this is useful for the UK. I think so. It's all based in the US code, but I think there's a lot of parallels with how equity works outside as well. So who are we, or rather, who am I? Since it's only me doing this workshop today, I am Ankur Nakbal. I'm the co-founder of Carry.com. Before this, I founded a company called Teachable that I scaled to a $250 million exit. I've also now invested in over 100 different startups, and a lot of my lessons are based on what I've seen along the way. For those of you that don't know about Carry, Carry is an all-in-one platform for tax advantage accounts, investments, and strategy for business owners and professionals. Financial education is such a big part of why we do what we do. So, educating people about their equity is something that we're excited to do. We also have a training library to teach people more. I'll show you where to get access to that afterwards. Cool. Pop quiz for everyone. On a scale of 1 to 10, how confident do you feel today in understanding the value of your equity? 10 is super confident. 1 is I have no freaking idea. I was probably a 6 or 7 before. Now I think I'm a 10, but I'll give it a 7 now. And I'd love to see where everyone comes in. While the answers come in, before we dive in, I should caveat this workshop is not tax advice, legal advice, financial advice, or investment advice. Everyone's situation is always different, right? So you speak with a professional before acting on anything you hear over here. Okay, cool. Chat is lit. I see a lot of 6s, 7s, 1, 2, 4, 6. My goal, and I'll check in with you at the end, is to see if by the end of this workshop, we can add 1 or 2 points to it. I can't make you an expert in 40 minutes, but I can probably, move the 1s to a 4, move the 6s to an 8. So let's keep going. I'll take one question before we start. So typically I don't, and we'll keep most of the questions at the end, but this is a good thing to talk about. How likely is is it likely for an employee to be able to negotiate the terms of the equity? I think it's very unlikely that you can meaningfully change the equity plan, as in, things like vesting period and so forth apply to everyone. It's very, very unlikely they're going to change it for one person. However, things like the quantity of shares, you can always ask. You can also, ask the company for more information to decide if that's a job you should accept. Cool. So here's the agenda. Let's start with part one. What is equity? Before starting, if you're ready, type into chat saying let's go or LFG or let's do this, and we will kick this show on the road. All right. What is equity? So equity 101. Equity ultimately is ownership of a piece of a company. The simplest way to think about it is even if you buy shares in the stock market, that is now an equity you own. Interestingly, almost every single wealthy person in the world, you look at the Forbes 100 richest people, they all got there by owning equities. A little bit of a sidebar, but even if you look at celebrities and athletes, a lot of them realize that the salary they make from their playing career or from performing is not as valuable as owning an equity stake, which is why many of them end up starting businesses or investing in businesses. The other thing is equity is also taxed at a lower rate than salary. So it grows more, it compounds, it's how you get wealthy, and it also has lower taxes, in some cases, no taxes. So it's super important to understand. Startup equity is a phenomenal asset class. Yes, it's very risky, but it has tremendous upside. It entitles you to a piece of the company you work for. It is an important part of your compensation for a lot of people. And because the company is privately held, that means there's no public market. You can't immediately sell your equity. You have to hold on to it for a period of time. Basic startup math to understand the value of your company is your share price multiplied by number of shares. It's a very, very simple equation, but you want to remember this because this is the same for a tiny startup as it is for Apple and Tesla and Nvidia and all of that. It's the same basic equation. The other reason I point this equation out is if you know any of these two numbers, you can calculate the third. So for instance, if you know how many shares there are and you know the company value, you can use that to calculate the share price. So remember this equation. We'll come back to it. So let's talk at a philosophical high level first. How should you think about equity? Before we get into any of the nuance on like number of shares and vesting periods and all the technical stuff, the most important lesson I want you all to leave is the quality of the business you work for is the single most important thing. Like the biggest difference in outcome is the company you work for going to be successful or not? You could have 10% of a company worth $0 and you make $0, right? Most startups end up being worth nothing. So be judicious about where you work, as that is the biggest and most important factor. Another thing I want to cover is even if you get to positions in your life where you may feel like you have a lot of equity, you're like, I'm a big baller, I have, $10 million worth of company stock. Remember, it's not a liquid currency. You cannot spend equity. So, be conservative, even if you may have equity that's worth a lot on paper. At the same time, be thoughtful about the equity you have, because it's one of the best opportunities as an employee to have what I call asymmetric upside, where something could be worth millions of dollars, many, many, many times your investment. All right, so for people in chat over here, who knows the type of equity you've been granted? Maybe it's options, maybe it's RSUs, maybe it's RSAs. We'll talk about all the equity types, but it's important to understand that as we'll build on it from there. Cool. Options, ISOs. ISOs are a type of options as well. RSUs, options, RSUs. Cool. Let's talk about the types of equity and the restrictions they typically have. So there's a few different types of equity that I'll talk about today. One is what most people have, which is stock options. The other is restricted stock, where you just get the stock directly. It's what we did at Carry early on. And then you have RSUs, which are typically restricted share units done by later stage companies. No matter what type of equity you have, they will all eventually convert into common shares without any restrictions. So restrictions, right? You may be wondering, why does this equity have restrictions? Well, the equity you receive is ultimately a form of compensation that is earned over your tenure. It's not like me buying shares of Apple where I pay dollars for those shares and I own them in an unrestricted way. These shares are typically restricted by how long you have been working at the business. The longer you work at the company, you vest your equity, the longer you've been employed. Vesting simply refers to the process of earning rights to your shares. So the types of vesting to be aware of, most people will only have time-based vesting. Time-based vesting is simply you need a certain amount of tenure to gain access to your shares. In some cases with RSUs, you may have milestone-based vesting where you vest if you achieve some kind of outcome. Like sometimes public company CEOs could have that where they'll vest their shares if they raise the stock price to a certain amount. Some later stage companies have hybrid vesting, which is a combination of time and milestone. But for most people, time-based vesting is what you have to think about. Time-based vesting schedules have a few components. One is the tenure, like how long do you have to be there to get all of your shares? The second is the cliff. What is the initial period of time you need to stay there to get any amount of equity? And then there's the frequency, which is after the cliff, how often do you actually earn shares? The most common structure is a 4-year vest, 4-year tenure, 1-year cliff, and quarterly or monthly vesting. This means you have to be there for 1 year to earn anything, but after that, you earn it out every quarter. At Carry, the structure we implemented is a little bit different. We added an extra year. It's a 5-year vest, but otherwise a 1-year cliff and monthly vesting. What happens after 4 years, after 5 years? Most companies issue refresher grants so that employees always have something vesting. A common myth to kind of break out of is once you are granted equity and start your job, you can always negotiate for more. You can always ask for another grant. There's no guarantee you'll be given another grant, but you can always renegotiate equity and not just upfront. Cool. Little fun question for you all. Who here can tell me what this image refers to? Tell me what it's called and why it's called that. I always find this to be a good example to explain, how vesting works. All right, Ratan's got it. Golden handcuffs. Golden handcuffs refers to when you may be checked out of a job or you may otherwise not be that engaged, but you have so much stock vesting every quarter, you're basically tied to the job because there's so much compensation tied to hitting your next vesting milestone. So people call it golden handcuffs because you're handcuffed to it, but making a lot of money through this. So it's a good point. It's often imaginary money if it's private and liquid. All right, let's talk about the specific types of equity now. Stock options are the right to buy shares at a certain price. This price is called a strike price, and this is the most common mechanism for early stage companies since there's very little tax complexity. Stock options are subject to only time-based vesting. It's what I did at my first company. However, with stock options, remember, you have to pay money in the future to buy your shares, which means more dollars that you have to spend to actually get your shares. There's two types of stock options. There's ISOs, which are only for employees, and these have slightly better tax treatment. Then there's NQSOs, which are applicable for non-employees. There's less favorable tax treatment, but it also makes consultants and advisors eligible. Don't worry too much about this now. We'll talk about it a little bit here, and I'll give you more resources later on. This gets a little bit more in the weeds than I want to for today. All right, let's talk about other types of equity. Outside of options, there's an RSA or a restricted stock award. This is similar to options, except employees buy the shares upfront. They own them immediately. They still have to vest them out, but by earning shares upfront, they start unlocking tax benefits right away. The downside of RSAs is you have to come up with the dollars upfront. So this only works in the early days when the company is very small. Um, RSAs are honestly somewhat rare, but in my opinion, they should be more common in the early days. At Carey, we did this for all of our early employees. They paid money upfront to buy their shares, but as a result, they started getting the tax treatment clock ticking. And we'll talk later about how you could have no taxes with QSBS if you hold your shares for 5 years. So a lot of our early employees have already held shares for almost 3 years because we did RSAs versus options. And then there's RSUs. RSUs are restricted stock units. These are common at later stage companies when the valuation is pretty high. These are granted so you don't have to pay money to buy them in the future, because as the company grows and grows and grows, buying options can become too expensive. Typically with RSUs, you don't have to pay anything to buy them, but you could be taxed when they vest. This is why they're typically subject to hybrid vesting structures. It can get complicated, right? Like as an example, Stripe had an RSU setup which vested after 7 years, which meant a lot of people ended up, owing a bunch of taxes. So they had to do a secondary just so people could pay the taxes. This gets a little bit complicated, but Cynthia brings up a great point. When does an 83B form need to be filed? So that's a really good point. One of the other downsides of an RSA, which is when you own the shares up front but are still subject to vesting, is you need to file a form called the 83B within 30 days of buying your shares. You have 30 days. And what the 83B does is it tells the IRS, I want to be taxed on all of this equity today, not as it vests. And the benefit of this is there's basically no taxes due because the company's valuation is the same as what you're buying the shares for. However, if you don't file that form, every time you vest in the future, it can be very expensive. All right, let's quickly recap. Stock options are the option to buy shares in the future at a certain strike price. Restricted stock awards are share grants that vest over a period of time. Restricted stock units are used by later stage companies to grant equity that unlocks over a period of time. Equity grants are almost always subject to vesting, and time is typically a big part of vesting. All right, who's ready to do some math? Let's talk about how to actually value your equity. So the most important tool in valuing your equity is something you already know, which is the share price. The total value of the company is the number of shares multiplied by the price of each share. If you're invested in the public market, you see share prices all the time. What's confusing about startups is startups often have two share prices. Public company, one share price, right? Like, wow, by the way, think about it. Shopify was only $68 when I took the screenshot. That was a long time ago. But public company has one share price. Shopify is trading at, I think, 100 and whatever, something now. A private company, however, has multiple share prices, two share prices to be specific, based on who's asking. So the two share prices are, one is the 409A price, or what I call the internal price. This is the price at which you're granted your equity. Companies want to keep this price as low as possible. If you have options, you get options at this internal price. External price is the price at which you raise money at. Companies want this to be as high as possible. And as an employee, on the date you're granted equity, the value of your equity is the difference between these two prices. By the way, good point by Larry. A new change now allows you to file an 83B online, which is a very, very welcome change. All right, how do you calculate the value of your equity? Very simple formula. Number of shares you have multiplied by the external price minus the strike price. So the strike price is going to be the internal price when you have the grant, but in the passage of time, the internal price can keep going up while your strike price stays the same. So this formula gives you the total theoretical value of your equity today. The goal is it can and hopefully will be higher in the future. However, remember, this value is fully theoretical. It's paper money. It's not real money. You can't spend it. But let's walk through an actual example, all right? Let's consider my buddy Abel. Abel is evaluating an offer from Exo Technologies, and he gets options on 10,000 shares at a 50-cent strike price. These options vest over 4 years with a 1-year cliff, Exo Technologies raised a funding round at $50 million, which was a share price of $5. Who here can tell me the total value of Abel's grant? So I'll do the quick math myself. $5 is the external price. Internal price is 50 cents. So it's about it's $4.5 per share. So that works out to $45,000 on a per year basis. It's $11,250 per year since it is a 4-year vest. But the interesting thing is every single time the company does better, this price actually moves up. Let's consider a couple of different scenarios. Exo Technologies is now crushing it. They raised a Series B at a $250 million valuation. So now their share price is $20 per share. Abel's grant is now worth $195,000. So now his competition is almost $50K a year in equity. And as these numbers keep going up and up, the value can keep going up. Okay, let's talk about the opposite scenario. Someone has ever asked me, this is all well and good. What happens if the company does poorly? So very theoretically, your equity value could end up being negative. This happens rarely, but in difficult markets, what could happen is you get your shares at a strike price. The company is worth a lot of money, but then the company does much worse, and they raise a down round at a much lower valuation that is actually lower than your strike price. When this happens, the term that we use is your options are considered to be underwater. They are valueless. They're worth negative money, so you'll never exercise them, but you're effectively working for zero equity. And if you ever find yourself in a situation like this, you should immediately renegotiate your equity because your stock options are worth nothing. They're technically worth less than nothing, so you won't exercise the option. So worth noting. Two other things that I find very important to ask for is percentage ownership and liquidation preference. I believe every startup employee has the right to know how many shares there are on a fully diluted basis. If you find out how many shares there are, you can divide the shares you have by the total shares and calculate what your percentage ownership is. The reason this is important is this is the best way of benchmarking if you're being compensated fairly on equity at an early stage company. If a company just tells you you have 20,000 shares, you're going to be like, what the hell is that? How do I know how much 20,000 shares are? So ask them how many total shares are in the business. And in my opinion, it is your right to know. Now, a founder may say, hey, I can't tell you that. The number of shares keeps changing. I would counter that with, look, I understand the number of shares will keep changing as we raise more money. That's very normal. I still deserve to know how many shares are in the business today. As I said, your percentage ownership will change. Like the pushback you will get is, as the company raises more and more money, more new shares are created. So your percentage will change, but that's okay. Think about, investing in the public market. I can invest in Shopify today in the public market and find out how many shares I own, how many total shares there are, and what my percentage is. Even though that percentage may change, that's still valuable information for me to know. But every time the company raises money, typically more shares are added, your shares stay the same, your percentage goes down, and this is what's called dilution. Chantal is saying, is valuation equal to the money raised? No, valuation is the total value of the company. Value of the company, I'll type it again, is share price multiplied by number of shares. All right, something else that's important to understand is liquidation preference. This sounds crazy, but you could own 2% of the company, but it does not mean you receive 2% of the company when the business sells, because you have what's referred to as common shares, while investors have preferred terms on their shares that are called preferred shares, which allows them to get their money out before anyone else. This is called a liquidation preference. And the way this works is investors, when a company sells, have the right to get the maximum of their percentage or the dollars they invested. So if the company doesn't sell for a lot of money, the investors can simply get their money back, which means there's less dollars that you ultimately can end up distributing. So if a company's raised $100 million and it sells for less than $100 million, typically you won't make any money, even if you own 1%, 3%, 5%, 10%, it doesn't matter. So always ask what the total liquidation preference is, because that is the minimum amount of money the company needs to sell for anyone to be worth anything. So what does this mean? Beware of companies that have raised 100 million, billion plus dollars that aren't doing super well. Because what it means is these companies have to exit for at least that much before anyone outside of the investors makes even $1. In some extreme cases, this liquidation preference could be a multiple on the amount raised. So always ask the founder or the recruiter or the recruiting team what the liquidation preference is. If for whatever reason they don't share or you can't dig up what it is, you can safely assume it's at least the amount of money raised as the floor. And again, in my experience, I've been in startups for 10 years. Be very careful of companies that seem to hide information. In my opinion, you should be able to ask for and receive the number of shares on a fully diluted basis, the most recent preferred share price, revenue and growth rate, how much cash in the bank, how much runway, how much have we raised. A question says, how can an intern ask for equity? It's scary to ask. If my intern asked me that, I would take that as a confidence signal, because it makes me think, they're evaluating what their equity could be worth. And Aaron has a good point. Maybe you do it when you're converting to full-time employment. All right, so to recap, I showed you how to calculate the value of your equity, how to calculate what percentage of the company you own, how to ensure your company does not have crazy liquidation preferences that make it hard for employees to make money, and just be careful of dark patterns of your company withholding sensitive information. All right, we're about 2/3 in. I'd love to just quickly check in, type into chat, let me know how you're doing. Is this too much? Is this too little? Is this useful? Is this helpful? For everyone asking, I will send both a copy of the slides and a replay to every single person who registers. So don't worry, just follow along. You'll get all the information later. We also have a special offer and a Q&A for anyone who stays live. All right, this is great. Can you do this from a founder perspective? Yes. I actually will have a course on personal finance for founders where I cover a lot of this from the founder perspective. VB, can strike price change? The strike price on your equity after granted does not change. But if you get a new grant in the future, that will be at a new strike price, which is the internal valuation at the time. Tony, how do I know the strike price? Any option grant will have the strike price written for you. Pyle, are you seeing oh, sorry. Yeah, Pyle, no strike price stays the same for you, but internal price will change. Nicole, I wish you were around to teach us when I joined a startup 10 years ago. I started my first company 10 years ago, and I had to learn about all this for the first time myself. So sometimes, by the way, I should say, right, like sometimes some founders, it's not nefarious intent. They're not intentionally like misleading you or something. Sometimes a lot of founders, especially younger founders, are learning this themselves. Like I was learning this when I started my first company. I didn't know any of this information. All right, let's talk about exercising your options. Actually, Aditya, till when does the strike price apply? The strike price applies as long as you have the grant. So till you exercise it. Ali says most companies keep the strike price regardless of how the internal price changes. Nope, you will go to jail for tax fraud. When the company starts, that is the strike price. But otherwise, every single year, the company is required to have a third-party valuation agency. Typically, this is where your cap table is hosted. So it could be Carta or Pulley or someone comes in and they conduct a valuation called a 49A valuation, and they set the price. You can't keep it artificially low. You need to have a third-party valuation at least once a year. All right, let's talk about exercising shares. I like to say all roads eventually lead to the same thing. They all lead to owning common shares in the company. You ultimately make money selling those shares, which can be when the company sells, when the company goes public, or there's a secondary transaction where people buy your shares. RSAs are already shares, so we're easy there. RSUs become shares when certain conditions are met, so there's a path there. Stock options are a little bit more complicated because they are only the right to buy shares, and you have to actually exercise your right to buy your shares. So exercising your options is you pay the dollars, which is your strike price, multiplied by number of shares to buy your shares. Two important things to look for in your options paperwork. One is early exercise. Some plans, like our plan, allows people to exercise the whole thing up front, even though they'll only vest it out after a period of time. And then the post-termination exercise window, which means after you no longer work at the company, how long do you have to buy your shares? Yash, so if a startup raised $2.5 billion and it's getting acquired for $2.5 billion, the founder owns 30%. Nope, typically the founder will not make any money from their shares unless there's something rewritten with the contract. Cool. So in general, look, owning shares is superior largely for tax reasons. If you hold your shares for 1+ year before selling, and this is shares, not options, you pay long-term capital gains taxes at a much lower rate. If you own your shares for 5 years before selling, you could end up paying zero taxes at all. If you want to sell your equity before the company sells or goes public, you have to own shares for a third-party buyer to be interested. A third-party buyer won't buy your options. Early exercise ultimately allows you to buy your shares before they vest. This is very useful to have if you join a company that's super early on, where the strike price is low enough. You're like, let me just buy it up front so I can unlock tax benefits sooner. Remember, when you do this, though, you could owe taxes on the difference between your strike price and the current internal prices, on the assumption you don't do it at the same time. Also, if you early exercise, again, you have to do the 83B form I talked about before. Sunny, what's the 5-year no tax mechanism? I'll come to it. We'll come to it. It's a good part. Okay, part 2 is post-termination exercise window. A lot of people get into trouble. Like, imagine you work really hard at a company for 4 or 5 years. You've earned your shares, but you're leaving for another opportunity. But you now have to decide, do I pay $40,000 to buy my shares, or do I forfeit my stock options? Because a lot of contracts say you only have 90 days to decide after leaving a job whether you want to exercise your options. This can be very, very challenging because if the company is far along enough, it could end up costing real money to buy your shares. It could end up costing thousands, tens of thousands of dollars. What a lot of newer startups are doing, and I do this at Carry, is we modified our paperwork to now allow for a 10-year post-termination exercise window. It now means an ex-employee will have 10 years to decide if they want to exercise their right to buy the options. So when you're evaluating your equity package, ensure you understand how long you have to exercise your shares after you no longer work there. So super important clause. A lot of people need to figure it out. Ishant, the 83B needs to be filed 30 days post-exercise before it vests. But right after you pay dollars to exercise, you have 30 days. Rodrigo, what happens if the company goes public before 10 years? Typically, then you're fine. They will automatically convert your options to dollars. You'll get paid for it. However, because you don't own shares, you won't get preferential tax treatment, but you typically will still get paid. Okay, when should you exercise your equity? Now, this gets tough. It gets into the world of financial advice. And, ultimately, I can't give you very specific advice. But my general framework is if the company is early enough that the shares are almost free, you may as well exercise it as soon as you can because there's very little downside. But later on, it depends on a lot of factors. And when it starts costing real money, like tens of thousands of dollars or more, I would think like an investor, right? I would be skeptical. I would try to evaluate the company unemotionally. It becomes a case-by-case decision. All right, to quickly recap, to own shares from stock options, you have to exercise your option to buy them. Shares are ultimately better than stock options for taxes because they give you more optionality. You should find out if your equity allows for early exercise and what your post-termination exercise window is. And ultimately, it's a personal decision on whether exercising your options makes sense, but it's a hugely important one, so no pressure. All right, part 5, and we're almost at the end here, selling your shares and taxes. So you ultimately make money when you sell your shares. This can be when another company buys your company, when your startup has an IPO and goes public. Maybe your startup finds a buyer for employee shares. You may have read OpenAI is doing a $6 billion secondary where there's a buyer for employee shares. Sometimes you can try and find a third-party buyer for your shares, but that's subject to a lot of restrictions. Srijit, do I have to wait for vesting to exercise options? Typically, yes, unless your option plan comes with an early exercise clause. Again, when dealing with equity, I don't mean to be a downer, but I always want to remind people, never ever forget the majority of platforms fail. The majority of startups fail. And when startups do succeed, it frequently does take a long time for people to see meaningful liquidity, 7 to 10 years. Usually you will not owe taxes until a liquidity event. The big exception is NQSOs, where you could owe taxes on exercise. If you have NQSOs and the company value is low, early exercise can be very helpful. And then remember, for RSAs, you need to file an 83B, and you can get into the nuance of AMT, which is a little complicated. I'm not going to get into it today, but I'll point you to a course where you can learn more about it, which could apply in some cases. I see Rodrigo's question about equity in Roth IRA. The short answer is yes, you can, but your company needs to support it, and you can't be a majority founder of it. All right, cool. Ultimately, how long you hold your shares determines your taxes. If you hold your shares for over a year, you pay long-term capital gains at a preferential lower tax rate. Short-term capital gains and ordinary income are taxed at the same rate, but short-term capital gains offers more tax planning opportunities since you can actually offset gains against losses. When you hold your shares, that is when the clock starts ticking. The clock doesn't tick with options. It only starts ticking once you have shares. So just to break this down, RSAs are immediately shares, so your clock starts ticking right away. RSUs don't become shares typically until liquidity event or something else. So the clock on holding shares only starts then. With options, the clock starts ticking after exercising. And for ISOs, in order to get preferential treatment, it has to also be at least 2 years after your grant date. All right, now my favorite reveal of this presentation. If you own your shares, like full shares, not options, for 5 years, you could pay $0 in US taxes. This may sound crazy, but the greatest tax rule for startup employees and founders is called QSBS, or Qualified Small Business Stock. And most startup shares count if you buy shares from the company when the business has raised less than $75 million. So you buy your shares from the company when the business has raised less than $75 million. You hold shares for 5 years or more. You could pay 0 federal taxes and potentially also 0 state taxes in more than 40 states. It's crazy, like insanely powerful. Ask your CFO if the business qualifies, but this can be such a big difference maker in how many dollars you keep at the very end. Cool. Pio has a question. Long-term capital gains applies for public companies as well, but QSBS typically doesn't because they're not a small business. Now, in general, owning shares for a while can be super useful because even if you don't hit 5 years for QSBS, you can do something called a QSBS rollover, where within 60 days you invest in another small qualified C Corp and QSBS can keep ticking. You can also potentially unlock partial QSBS after 3 years if you've bought the shares after July 4th this year, where partial QSBS lets you get a 50% deduction for holding shares for 3 years and a 75% deduction for holding shares for 4 years. You can also, if you end up having more than $15 million, gift these shares to family members, transfer them to a trust, and ultimately multiply your QSBS limit. So to quickly recap, and by the way, I'm seeing a lot of questions. I'll cover them all very, very soon. Wanted to recap and kind of share our special offer, and then we'll do the Q&A. All right, so to recap, you only make money when someone buys shares. How long you hold the shares for makes a huge difference in how much tax you end up paying. You should find out if your shares are QSBS eligible from your company upfront. Owning shares directly will give you a lot more options to maximize value and minimize taxes. All right, let's recap and bring it all together, and then I will, set you all free after a little special offer and Q&A. So, to quickly recap my big lessons, how to think about equity. You cannot spend paper money, right? As tempting as it may be to say I have millions of dollars in, startup equity, you can't actually spend it. The quality of the company you work for is the most important factor. When negotiating your equity, calculate the percentage of the company you own and find benchmarks for employees at the same stage. It's a massive red flag to me if the company is not transparent about your equity. Owning shares directly versus options or RSUs will give you the most tax and liquidity benefits. But also finally, personal finance is personal. Decision on whether to exercise your equity or sell your shares depends on your personal financial life. Factors in your life, like how much money do you have saved up? Do you have dependents? Do you have children? What are your goals? How much risk you're taking with your other incomes, other investments? These are all big factors as well. So always speak to a qualified professional. The parting note is I still think for most people, equity is our best shot at building real generational wealth. Even though most startups fail, most people that get wealthy do it by owning equity. For most people, it's one of the only bets in our portfolio we will make with asymmetric upside. And the cherry on top is after all this, the equity is also taxed at a lower rate than your salary, including potentially zero taxes. With that, we are at the end of our presentation. It's 2:42. I went 2 minutes overboard. I'd love to know in chat what has been your biggest takeaway. Type it into chat. I'll read out some of the options. And meanwhile, I'll give you a special discount to our premier education program to get smarter about these things. Shweta says, can you point to the course in Carry Lab, which is our special education product? We have a discount for today that tells you more about this. So you can read out your biggest takeaways. I'll read out some of the answers, and then I will cover the special offer, and then we'll do some Q&A. So again, we've put together a special offer for everyone in this workshop today, introducing Carry Lab, which is the learning hub for mastering money and growing your business as a founder or as a startup employee, step-by-step courses, tools, and expert guidance for entrepreneurs and employees. So why do professionals use Carry Lab? It is a training platform to master topics like tax savings, cash flow management, business growth systems, step-by-step courses, tools, and resources created for entrepreneurs and employees. Learn at your own pace. It's 100% online content designed to fit your schedule, all for less than a Netflix subscription. Shweta is already a member. The price we have today is only $99 a year, so it's literally cheaper than Netflix or Hulu or anything. Hold on. Okay, there's a little bit of someone is saying there's an error signing up at Carry Lab. Let me just check what the issue is. We'll fix the link. We'll fix the link. It's coming soon. I'll get you all a working link as well. Meanwhile, let me tell you more about what Carry Lab is and how you can get it. So again, we have courses on all of these topics. We have a course on equity compensation, which goes deep into how to find the value of your equity. Course on people who were considering becoming founders, like raising your first round of venture capital, angel investing, personal finance for startup founders. Okay. Yep. VB has a better link. I will update the banner as well. Yeah. Thank you for that. Go.carry.com, Carry Lab. Thank you. You're a lifesaver. You can use the coupon code OOOCARRY as well. Okay, there we go. And yeah, our entire course library, which is strategy to save money on taxes, tax planning, credit card points, personal finance 101, lots of stuff over there. And now until August 28th, until midnight Eastern, you can use the new URL at the bottom to get everything for $99 a year using the coupon code OOOCarry. And a special bonus for everyone who joins us before today, we'll give you $99 off our big in-person conference next year in New York, plus free replays from the event. So you get all of this stuff, the library of courses, all the future courses, live workshops, replays to the conference, all for $99. So I see some questions. I'll very soon cover, I'll just pull it up and I can show you guys exactly what it looks like so you can judge for yourself. But meanwhile, if you have any other questions on the workshop content as well, keep it coming while I pull all of this up. And by the way, thank you all for sticking with me. I know learning about equity, it's like the last week of summer. People could be doing a lot more fun stuff. It's pretty awesome that all of you are here today, learning about the value of equity. Cool. Here you can see, by the way, if you're a regular Carry customer, you automatically get access. So don't worry about this. It's under the Learn tab. But for everyone else, you can sign up just for this. You can see we have all the conference replays, past all the workshops we've hosted. You can watch them over here. There's ebooks, there's events, there's courses. Within the courses, there's courses on starting a business. There's a profit playbook, equity compensation. This is, again, stock options, RSUs, more really understanding founder stock, employee pool, NSOs, ISOs, RSUs, single trigger, double trigger, public offerings. This gets in a lot of detail over here. Someone was asking me about the founder course. This one is Personal Finance for Startup Founders, where we look at equity and incorporating in QSBS from the perspective of a founder. This course is on all kinds of topics. It's Personal Finance 101, credit card points. I have a course on 25 strategies to save on taxes. There's a lot of good stuff here, which honestly at $99 a year, I think is a pretty good deal. Cody says, I have an offer from an early stage startup, but the only comp is equity. Is that normal? That's super not normal. I would say you definitely want to also have cash. It's cash plus equity. This seems like a very big red flag to me if they're not also paying you for your time. Abhishek, what if a startup doesn't offer equity shares or being able to buy shares? I mean, look, I would ask for it. And if not, I would look at other companies where you may have a chance. If not, I would otherwise just tell people, tell them they need to pay you even more in cash to make up for it. So, I would think very strongly about whether that makes sense or not. To me, one of the benefits of working at a startup is the equity upside. Meryl, what if a company has significant growth and a little outside investment? I assume that makes stock options way more valuable. Yes, I think that's the perfect sort of place. If a company doesn't raise much money while building massive enterprise value, that's when employees can do really, really well. Yep, Adam has a good point. Joining pre-finance startup, getting equity only. Yeah, I guess that makes sense. Adam says if it's a temporary thing where once they raise money, they'll pay you, yeah, that could be fine. Okay, a little bit of a complicated question. What mistakes were made in the Windsurf situation? So Windsurf, if you guys didn't see it, was a very weird deal where basically the founders sold themselves in a structure outside of selling the company. Honestly, as an employee, I don't think employees made a mistake. I think one of the other things that's worth evaluating is the integrity of the founders you work for. I think that is so important because you can do everything right as an employee, but if your founders want to fuck you over, there's typically ways for them to do that. So I would say the sort of lesson there is when you're evaluating a company, you're also taking a bet on the integrity of the founders you're working for. Jess, can founders have preferred shares? Typically, they don't. there's something called founder preferred that allows shares that a founder has to be sold in a secondary. That's one option, but straight preferred shares rarely happens unless the founder is also investing. TZ, is it always a good idea for founding employees to receive way more equity? I've heard doing so can screw up the cap table and future prospect of the company. Is that true or gaslighting? It's a really good question. My personal belief is employees should earn much more equity than typical. What we do at Carry is we still use equity benchmarks, but we are closer to paying, I would say, like around the 90th to 99th percent of the benchmark for equity compensation, which isn't screwing up the cap table. It's, but I still think it's rewarding employees much more. Christopher, I'm a founder. We're getting ready for the first fundraising round. Do you have strategies to minimize the impact of inevitable dilution? This sounds cliched, but if you can raise money from a place of strength where you don't have to raise money, that's the best way to prevent dilution, where you can raise small amounts of money while protecting your business. I know it's a little bit of a frustrating answer because, of course, it makes sense and it may not be something everyone has a choice to do. But if you're in Carry Lab, I highly recommend watching this, raising your first round of venture capital, especially the stuff around the market, the traction, as well as pricing your round. This is a really important video. Watch that, and it has some stuff. Sumit, is it typical for founders to pay themselves stock options from the employee stock option pool? It's not typical, but it also happens sometimes for refresher grants. It doesn't necessarily dilute the employee's equity, but it's a conversation you should find out. Basically, just track how much equity you have and see if that starts changing with time. Michael Trang, what are the biggest red flags? Okay, I have this one slide. I think if a company doesn't share this information with you, that is a red flag. Okay, yeah, this is this slide. If they're not willing to share this with you, that's a red flag to me. Shivam, is 4-year vesting with 1-year cliff standard? Can there be shorter or accelerated schedules? This is pretty standard. As a founder, I'm actually pushing for longer vesting. I did 5-year vesting for my company and I actually wish I'd done 6 years. So you can go shorter, you can go longer, but my learning with startups is it takes so much time to build value that I would personally go longer versus shorter, but you can try negotiating for shorter. Aaron, can you talk about what drives the difference in the 409A stock price versus external price? Yeah, so the science behind it is technically the 409A stock price is for common shares, while the external price is for preferred shares. Preferred shares have slightly better rights, and as a result, they command higher prices. However, the internal game is fully different. When I'm fundraising for my startup, I am trying to pitch the grandest vision of what it can be. I'm basically telling investors, look, this company is going to be worth many billions of dollars. You can invest in it for, $100 million or some pretty high price. And, I talk about how amazing my company is. I want to get as high a price as possible. So for each dollar raised, I have to sell less of my company. However, when it's time for my 409A valuation and I have the valuation agency come in, I completely switch my narrative. I tell them, look, we're fucked. We have no revenue. We're not profitable. It's shocking this business is even surviving. I don't know if this company's worth anything at all. Of course, they look at it and they're like, look, you just raised at a $100 million valuation. Your company's worth at least $25 million. And then we'll negotiate and maybe they'll say, look, your company's worth $20 million. But it's a fully different song and dance based on which fundraising, whether you're fundraising or doing an internal valuation. All right, we only have a few more minutes, but if you end up wanting to get the special offer, I'll just recap it. You can get Carry Lab, which is our learning platform for all of this education for less than the price of a Netflix subscription. If you buy while we're live, you get courses on equity compensation, raising venture capital, angel investing, personal finance for startup founders, all of it for only $99 a year if you use the link at the bottom with the stated coupon code. The short link is not working, and I apologize for that, but go.carry.com/carry-lab with the coupon code OOOCarry. This offer is alive for as long as I'm live on the webinar. If you end up coming in a little bit after, you can also email hello@carry.com to get the offer or with any questions. Sanjana, what is the reason there's two values that exist? It's because when shares are granted, they're granted at the internal price. And the reason that's useful is that's the only way your stock options have some value. If you're giving, let's imagine you're a public company, right? If you're a public company, you have to handle equity compensation very differently because there's only one price at a given time. Aaron, on external price versus 498, do founders have an incentive to depress the 498 price? Exactly. I want my 498 price to be as low as possible. I will fight for a lower 498 price. In my personal finance for founders course, I actually talk about why founders should actively be negotiating for the smallest 498 price. Shane, should startups share cap table info? I think you don't have to share your full cap table, but I think you should share how many total shares are outstanding, as well as the 498 price and the external price. Can you repeat the web page? Yes, I'm also typing it in. There's also a banner at the bottom. It's go.carry.com, carry-lab, coupon code OOOCarry. The annual plan will get you all of this for $99 a year only. With that, we are sadly at time. It's been an incredible hour. Thank you all for coming. To recap, I'll make sure to send the slides. I'll send the replay. But I just hope everyone here has learned something. There's too much information to cover all I can do in one sitting, but I try to do the best I can. A little fun game before we wrap up. All of you rated, what your knowledge was on a scale of 1 to 10 before this workshop. I would love if you post the new rating with the old rating in brackets. So I was a 7. I'll say now I'm a 9. So I'll type in 9 bracket 7 just to show and see, if anyone here has actually improved their understanding. But either way, check your email, expect a replay soon, expect the slides. It was such a blast to have you all, and we'll keep hosting new workshops like this all the time. A lot of my coworkers are going to host and my co-founder Jess actually is hosting a workshop on Thursday on how to reduce taxes. I'll post a link to that as well. Tax saving webinar. And yeah, the link for the offer is go.carry.com/carry-lab. It's at the bottom. Use coupon code OOOCarry for the discount. The discount is only on the annual plan. Someone is saying the code is not working. The code works on the annual plan for Carry Lab only, but hello@carry.com, I can look into that as well for anyone saying they're not seeing the offer. And let's imagine you buy it and it charges you the full money. Email hello@carry.com. We'll issue you a partial refund. So we'll make it work. Cool. All right. With that, thank you all, and I'll see you all very soon.
You're focused on growing your investments, but what about the cash that's just sitting there? After taxes and inflation, even cash in a high-yield savings account might be falling behind. That's where Smart Yield by Carry comes in. It's an investment product that automatically moves your cash into high-yield money market funds. Here's how it works. Smart Yield scans a strategic list of money market funds every single day, then compares them based on your personal tax situation. Some of these funds can offer special tax advantages, like no state and local taxes, no federal taxes, or even both, depending on where you live. And when a higher yield becomes available, Smart Yield is designed to reallocate your funds automatically. No spreadsheets, no guesswork. Just another way Carry aims to help you keep more of what you earn. Learn more about Smart Yield at carry.com/smart.